everybody. Thank you for joining our session today. I'm really excited for this chat on bringing debt capital markets on chain. We have an extremely exciting group of folks to talk about this topic, which is really impactful in the crypto space right now. And the panel is so great, I'm going to shut up and let them introduce themselves. So please.
Hello there. My name is Erbil. I'm a co-founder of Huma Finance. Huma is an open protocol for building next-generation DeFi applications. In the first generation of DeFi protocols that were quite successful, we know that that success was partly attributed to them mainly being smart contract-based automated markets, and yet they were also heavily reliant on over-collateralization of digital assets, and that created a market about this size. And we believe the future of DeFi is also automated. However, it also has to be a lot more capital efficient, and it needs to support many more use cases. And then the market opportunity is going to be much, much bigger. Yet, for that future, the infrastructure was mostly missing up until now. And this week, we just launched our alpha version on Go to testnet. Yep, thank you. And we're bringing three main innovations to make that future possible. The first innovation is understanding cash flow and income. If you want to get a business loan, if you want to get a mortgage, if you want to get a car loan, personal loan, the most critical information the underwriters ask for is cash flow and income. And that information never was available, accessible to DeFi before. So with our income portfolio adapters, we're making on-chain and off-chain income information accessible to lending protocols. It's an open protocol. It's an open platform. Any developer can write their income adapters and participate in our markets and earn a portion of the protocol revenue. The second innovation is machine learning-based risk models. So this information from these different income sources are feeding into a decentralized infrastructure for machine learning models to run. And these models can plug into lending markets, staking junior capital, basically competing only on performance and also earning rewards. And this makes a new type of markets possible on-chain. And the third innovation is receivables instead of collateral. Today in DeFi, collateral refers to a very, very limited set of assets are used to back debt. And we're introducing receivables similar to structural finance, where you have infinitely more number of receivables that can be used for securitization. So we're making them also available on chain, so anybody can launch a lending market backed by those. So all those innovations enable different types of markets, very customized lending and risk markets, factoring markets for crypto invoices and payments, but also a credit line for every wallet. So think about it. Today, your wallet is more like a dump, debit card. Why not in the future? It worked more like a credit card.
Thank you.
My name's Sid Pal. I co-founded Maple Finance. So Maple Finance is a capital market built on chain, with the idea being that you can set up a pool, effectively run a lending business or a credit fund type operation on chain. And it's mostly focused on institutional borrowers as well as institutional lenders who are the prime users of the platform. So we launched in May of last year. We've done about 1.8 billion in originations to date, and very excited to be here.
Thank you.
All right, very nice. So hi everyone, my name is Thomas. I'm the founder and CEO at Credix. We're a debt capital markets infrastructure that connects institutional investors with fintech lenders. We're doing that by having built a DeFi protocol that allows those fintechs to tokenize and securitize their assets. And when I speak about assets, it's mostly non-crypto correlated assets like car loans, invoices, receivables, mortgages, any kind of credit product. And then on top of that, we have built a marketplace and ecosystem with a set of sophisticated credit underwriters, being it traditional credit funds like, for example, Victory Park Capital and MGG Investment Group that we have live on the platform today. And then we bring in alternative asset managers that supply liquidity for the senior pools of these kind of deals. We have been live now for about 6 months, going towards 100 million of assets originated on the platform. and mostly focused on emerging markets, Latin America in particular today.
Hi everyone, my name is Sashir. I'm the co-founder of Spectral Finance. We focus on credit risk infrastructure in the Web3 world. So meaning like on-chain credit scores. We started by building an actual on-chain credit score called a macro score. It looks very similar to like a FICO score, which you may be familiar with, translating things like length of credit history, credit mix, health factors on-chain, your repayment history, default and liquidation history. But this larger vision of what we're working towards is actually trying to make credit scoring a publicly accessible network. And so that means not allowing these gatekeepers that we're used to, such as these bureaus that have cemented themselves over the last couple of decades, and also kind of social credit scoring systems that we're seeing in other jurisdictions. How do you kind of disintermediate these middlemen that have kind of a stranglehold on our financial reputation? We also realize, in the DeFi world, credible product market fit, obviously, but it's kind of currently in a very capital inefficient market, meaning that, everyone in this room will be receiving the exact same lending rates. So regardless of your wallet transactions, your repayment history, it actually does not matter. You're gonna get the exact same interest rates that everyone else will get. And so first step toward this is really trying to bring some capital efficiency to this market and then start to kind of work towards this larger disintermediating of on-chain credit risk infrastructure.
Amazing. So maybe we can start with the idea that, and I think the audience is probably familiar with the concept that DeFi is showing so much promise, so much innovation is happening in this space, but maybe they're less familiar with where adoption is happening. And Sashir, I'd love to start with you. Where are you seeing adoption? Where are you seeing take-up happening in your business, in your platform, and some of the reasons why?
Yeah, so we launched our beta about 3 or 4 weeks ago. So far, almost 40,000 people have come to check their on-chain credit scores. And very interestingly, we've seen a lot in the US and then also in East Asia. I think it's one of the reasons for that might be because, some of the social credit systems that exist over there. And a lot of people are used to, financial reputation, but I don't think we realize how much it's permeated into their everyday lives. And so you can get kind of blocked from booking hotels. It's actually part of your dating profiles. And so this is an opportunity of a new kind of financial history that you can kind of start over. And so we're seeing a lot of adoption there, a lot of people coming to check their scores, a lot of people in the community emerging from there, and also in emerging markets in Southeast Asia and South America. And so interestingly enough, in primary markets like in the US and North America, we're used to having a credit score. Credit risk infrastructure is natural and kind of just socially and mentally we just buy into it and live our lives according to it. But in these other emerging markets, they've never even had a credit score before. And so instead of being supplemental, we would become primary in those markets. And then a lot of new interesting things become enabled.
Yeah, that's super interesting. And I think particularly in light of some of the events that we've seen over the summer, the idea of a decentralized platform that offers credit risk infrastructure feels like it's really important. Can you talk a little bit about how some of those events have shifted the focus on your company?
Yeah, a lot of the early events that you're alluding to this year kind of revolved around trust, right? So how do you trust a borrower's financials? How do you attest to that? How do you validate and authorize it? And so a lot of these people on this panel are actually figuring this out in different ways. For us, ideally, the goal is trust minimization. There's always slight levels of trust, but how do you try to transition? And what we're already seeing from this migration from TradFi to DeFi is that a lot of people are using on-chain financials and DeFi for different purposes, back office efficiencies or full on-chain transparency. So there's a whole spectrum of this. The closer we can get to full on-chain transparency, obviously the better. And so, a lot of these things that kind of set back the industry in these early events really triggered this idea that we need to start transitioning faster into DeFi. And really the best part about it, one of the best parts about it, is that while all these events occurred in this kind of Web 2 CDeFi world, was that the DeFi protocols just chugged along seamlessly. Right? They did exactly what they were supposed to do. There was no lag time. There was no kind of, large kind of unknown liquidations or anything like that. Everything operated seamlessly.
How are you dealing with, just to ladder off of a couple of those comments, how are you dealing with the availability of information on chain and porting that into an ecosystem that desperately needs your services?
Yeah. So I think currently we're in a hybrid phase of the industry, right? So there's a lot of straddling of Web 2 and Web 3. And so I think one way we see that is that retail-based applications like Venmo, PayPal, Cash App, and WhatsApp is going to start rolling out. A lot of normal people will actually have exposure to Web 3 transactions. And so that's in globally, right? And so We're seeing adoption with crypto assets in South America, Southeast Asia, as I mentioned before, but even right here in the US, as a lot of these retail-based apps start rolling out, more normies will actually have Web3 financial transactions as part of their larger financial history. But right now it's completely neglected. And so we have an opportunity to actually act as this kind of blurring line of Web2 financial history and Web3 financial history when it just should be just financial history.
So it feels like the idea of credit risk and notably counterparty risk and the need for more clear diagnosis of those things, particularly on chain, is both a challenge and an opportunity. I think, Thomas, you're probably seeing similar themes and thinking about similar types of challenges in your platform. Where are you guys right now with some of these?
Yeah, definitely. So I think if you look at it, we had crypto as a native asset class, and we saw a lot of innovation happening there. And I think now if we want to move to this not $100 billion target market, but to this $1 to $10 trillion market, we have to bring more of these kind of assets on chain. Now, of course, everybody can tokenize an asset, but the question is like, where is the data coming from? Who is verifying this? And the biggest challenge, like, what if anything goes wrong? So the collateral sits off chain, the data sits on chain, and how do we all bring that in a more efficient way onto the different kind of platforms? Now, there we are with Credix, of course, looking at different kind of integrations and oracles, different kind of systems with different tranching mechanisms on chain to protect that downside risk. But in an ideal world, through stablecoin adoption, through the adoption of these kind of identity systems, we can start bringing the whole end-to-end flow on chain. And we believe that that would be a true game changer, when you can have a fintech company that underwrites, for example, a set of car loans directly on chain. They can do that based on on-chain credit history. We can start packaging that as a tokenized collateral, and we can start thinking about smart contract-driven and programmable covenants on top of those financial products. And there is a long road to go there. But I think the power that we now have, and coming back to the topic here with, hey, debt capital markets on chain, is we can truly rethink what is going wrong into the opaque legacy traditional finance system. So we can rethink parts of the identity process, rethink parts of the origination process, and rethink parts of the distribution process, and do that in a more composable way between the companies that are sitting here on stage, for example.
Mm-hmm. And do you think with some of the value add that DeFi platforms bring, notably on Credix, you're seeing a take up and adoption as a result of some of the shortfalls that we saw in CeFi over the summer?
Yeah, definitely. So I think, first of all, where we are operating in emerging markets, there's just a massive liquidity gap. And I think by standardizing, being able to do cross-border settlements, we can already solve a first issue, which is new kind of liquidity. By using technology and digitizing, we're saving like 200, 300 kind of basis points for these kind of instructions. And then there is the long-term play. And the long-term play comes back to that, hey, let's truly rethink how credit works today. Let's think about business model innovation. Today, credit is very local, siloed, based on risk-free rates and based on what the central bank decides to do, like what we have seen this morning happening in England, for example. Now, what if you have like DeFi protocols like a Maker, an Aave, and a Compound, and then can start being integrated directly with these kind of products? We rethink the way that risk is perceived and structured, and we believe big part of the innovation and disruption will come from there.
That makes a lot of sense.
Are the loans denominated in US dollars to emerging markets?
Yeah, so that's one of these points, right? So everything is denominated in US dollars that we do, so that means that we have to go off-chain and do hedging, which is a costly and a cumbersome process. Now, there are these amazing protocols that are bringing like now also foreign-denominated stable coins on-chain, and then there are even smarter people building options and futures on top of that. And so that will allow us now going from like a 7-8% off-chain cost to like a potentially 100, 200 savings that we can do by bringing that on-chain. And that's that composability of DeFi that I also think is very powerful.
That makes a lot of sense. So I think what I'm hearing is, with the advent of more of debt capital markets coming on chain, and I think there are sort of two vectors there. One is product oriented, of products and services coming on chain. The other is process coming on chain, different pieces of a flow of funds and a process to, for example, underwrite a counterparty coming on chain, create two things that feel really important. One is transparency and the other is accountability. And I know, Sid, we talk about that a lot with respect to Maple. How has that helped you to grow your platform?
Yeah, transparency is very valuable. And I think just to recap what you were saying before, Patrick, so there are two vectors. There seem to be, if you're doing capital markets on chain, there is risk management, which is one of the things Thomas was talking about with tranching, covenants that are triggered by on-chain events or oracles. And then there's capital formation and distribution. And so where we sit in the stack is more leaning towards operational efficiencies coming out of using the blockchain. But as you said, getting back to transparency, I think it was hugely important to see the difference in transparency between lending occurring on-chain through platforms like Maple and lending that was occurring through CeFi businesses. So when lending was occurring on-chain, you could look at all of the borrowers who were in a pool. So you're never surprised that there was a counterparty who might have been 50% of one of the pools. That just couldn't have happened because you would have seen it since the loan began. And you could also see that all of the loans were performing in real time, and you could see that cash was coming in and what was happening with that cash. The other thing that smart contracts allow you to do and doing lending on-chain is, of course, the non-custodial aspect. So, Maple has pools, the pools originate loans, but the pools are not custodially held by one party. And so this means that you could have risks or issues come up in the party who's managing a pool that do not impact depositors. As long as the loans are repaid, the depositors could always withdraw their funds. And this is very different from the CeFi business model, where you could have a risk in one other part of that business would impact depositors and did impact depositors. So those are two of the themes that we've seen come through.
That makes a lot of sense. So I'd take that over, Herbal, to you. How are you seeing some of these themes impact your business?
We think about this quite a bit. I think going all the way to Sisher's point, there are a couple of conversations happening. One is around composability, which we should definitely see more of. But when we talk about composability, we tend to talk about composability between different DeFi protocols. I think we should think much broader. We should think much broader of composability of DeFi with other infrastructure elements. And that's where we spend a lot of time. Also, interop is similar. We talk about interop between different layers, layer 1s and layer 2s, but I think interop should also be thought much more broadly. The main challenge is when you try to do everything on chain, there are so many limitations. There's so many limitations from one, first of all, purely technical perspective. You can only do so much on chain. You can only do so much computation on chain, only store so much data on chain. So you need to figure out basically how to bring in information sources from outside, yet still be able to compute them in a very heavily intensive way. This is the innovation that went into our machine learning models that are not necessarily on-chain models. They are Python models, but they are actually talking to on-chain contracts that are making the distribution of this capital happen. And instead of purely focusing on computational verifiability and security of that, I think we need to introduce economical models as well. So like how do you introduce alignment models, for example, for different counterparties or different people incorporating their input into this market so that you're not only basically trying to fit everything on chain, but making sure any bad decision or bad actor is getting penalized down the road with these economic incentives and alignments. So I think those are the aspects we tend to think about a lot. And with the launch of our platform, we'll see which parts we're right, which parts we're wrong.
Yeah, no, that makes a lot of sense. And so now we're getting into some of the structural challenges of adoption. Some of that's technological, some of it's availability on chain, some of it's innovation happening elsewhere in the space. I tend to think one of the challenges can be knowledge and perception. Would you agree with that? And if so, maybe share a few thoughts.
Yeah, totally. I'll start with basically our own challenge when we started looking into DeFi and overall smart contract development. We had our own doubts, let's say, based on what we were hearing, what we were reading, and we weren't really sure if this was really in the future of finance or if it's really a safe place for for us to act on and for us to participate as operators. And obviously, after we put our hands into building and start also having conversations with other participants, we realize quickly that some of the perception is just perception on surface, but it is still heavily blocking adoption. And it doesn't help that we have also, time to time, a lot of bad actors, take over the whole news cycle across the world. And I get, messages from my 80-year-old, grand uncles saying, I'm probably doomed to fail because I'm operating in a shady market. That's the perception they have because they read, everyday newspapers, and a few bad actors can ruin everything for everybody else.
Yeah, no, it's amazing. This is the second panel I've been on today where convincing your grandma that it's okay to use crypto is the measure of success. So, Sid, I love your thoughts on that. I really think this is a real challenge. How are you guys trying to tackle that?
Yeah, I think perception of the digital asset space is probably the number one challenge you face in trying to get new customers to use whatever product you're creating or a service you're creating. And so I think, one of the things, as we talked about, is the advantage of doing this on chain is the transparency. And so I really do think that a lot of what holds products or startups in this space back is just demonstrating what you've built. So people aren't really tickled by hearing the technical description of what you're doing, but if you can show them how to use the product, how it works, the advantages of using it, I think speaking to them in a fairly transparent way that gets away from technobabble and starts to talk about concepts they actually understand in really simple terms is how we further adoption. So it's a lot of kind of almost proof of work. You just have to be out there. That's why we do the conferences. That's why we do podcasts, webinars, and meeting people in person. And so I think the more we can get away from this idea of like anonymous teams only visible on Twitter, and the more we can be in front of people talking about the products we're building, I think that's where, that's how we further adoption.
Yeah.
And, they do say that science advances one funeral at a time. So some people just aren't going to get it, but every year there are new people entering the space, which is positive.
And I think maybe to add on top of that and fully agree, I think we, as the first companies in this space, we really have to put in the effort and the time to build out the ecosystem around this. And I think a lot of times in the ecosystem, the question is still very short-term focused. Like, okay, what is the value of doing this on chain? And there is always like the efficiency and the transparency and all those kind of things, which is definitely true. But I think there is a bigger vision of bringing everything on chain and letting all of this work, where we can really say like, hey, today, there is not such a thing as a global financial market. Like billions of dollars are stuck like in transit or not really generating yield. Like 90% of the financial asset classes are not accessible to most of the people. And it's really by bringing this on chain as a first step and tokenizing it, and then starting to connect it all to each other, providing the transparency, educating about why transparency is important, integrating with the different kind of composable protocols, that we can get there. And it's definitely not always an easy pitch if you have to do that to an institution like a BlackRock or an Apollo or a KKR that sits on $500 billion assets under management and that thinks like, we're doing just fine as it is today. And we do see there, I think today in this bear market, a first move where they, for the first time, really start to realize like, actually this might be happening. And actually we might want to be at the forefront of this. And so for that challenge, I think indeed it's a lot of education and getting more adoption.
Yeah, I think the idea of perception for us is particularly interesting because credit scores are kind of like a easily digestible narrative that exists already. So a lot of people, we get a lot of pushback around this idea of like, are we just copying and pasting kind of like this like resentful idea of credit scores that a lot of people don't really like, and are we just taking that and just recreating it on chain? So this idea of education isn't necessarily just around like, what are blockchains or the benefits of it, but it really is about, how are we kind of disrupting existing infrastructure? And so for us, it's not necessarily just creating a separate on-chain credit score, but it's this idea of bringing the values of transparency and disintermediation there. And so for us, we create like this global network of scores. And so it's not like a single source of truth anymore. And so for us, it's very much that, copying and pasting is never sufficient. And, generally across the board, I think that's like the trend we're going in for a lot of protocols in the industry. But that level of education really has to come over time to prove that, we're not just a kind of opaque, siloed kind of copy and paste from existing financial infrastructure.
Mm-hmm. No, that makes a lot of sense. Is sort of, and by the way, something we are also very much dealing with, is the lack of regulatory clarity a challenge? And if so, how is that impacting your business? How would that potentially accelerate adoption? I'll bring it back to you, Erbil.
Probably we are less impacted because we just got on testnet this week. But it is obviously, top of mind because we also come from, fintech background, and we have seen how that might hurt the unclarity, in your regulatory kind of spectrum, can hurt greatly because one, even if you have the best intentions to do everything right by, the consumers or the businesses you're serving, just the amount of time you spend making sure that, one, you're compliant and the partners that you want to work with will work with you because they also understand that you're compliant. There's like tremendous amount of energy that goes into that instead of just serving your, business partners or clients. But also, it impacts, unfortunately, as it, derails you from being able to also innovate in the infrastructure elements and the product side as well. And, we're just seeing this on our side where everything we build, we go back and check in with our, obviously, lawyers, and we talk to almost every single, crypto lawyer known, at least in the United States, and the answer you get is the same. It's like, we don't know. Yeah. And if they don't know, we don't know.
For an answer, they usually give you a different answer if you talk to each one.
That's right. I mean, eventually nobody really knows, and we were in a panel with some, regulators a few months ago in Austin, and even they were saying, there are different priorities that keeps changing within those, agencies, and they also have no clue when there's going to be, regulations and different aspects of it. Most likely, what's happening in stablecoins is a good start, and we just want everything to be more clear because it helps us as innovators to build faster and not be, just pulled back every single time by people asking us questions that we also don't know the answers to.
Yeah. So you're saying it's really good to be a crypto lawyer right now.
Oh, it is.
That's a good place to be.
They're receiving a government subsidy of epic proportions.
Indeed.
That's right.
I'll kick it over to you, Sid. How are you seeing things?
Yeah, so, I mean, regulatory clarity would be super helpful. How it prevents institutions from participating is they might be concerned about facing a smart contract as a counterparty. So, for example, depositing into a Maple pool would be them facing a smart contract, and then from that pool, loans are originated to known KYC'd institutions, but the institution we're talking to might have an aversion to just facing the smart contract. So even though they know where the money is going to go, that all of those participants have been KYC'd, they still wouldn't be able to get it past their compliance team. And that's a direct result of the lack of regulatory clarity, because they, in turn, could go and speak to 3 different law firms and get 3 different answers around whether they are doing something illegal or not. Right. And so that's the indirect cost on the sector. It's the opportunity cost of not being able to kind of transact, do commerce, because people are waiting for an event that may or may not even come in the next 12 months, let alone 18 months.
Mm-hmm. That makes a lot of sense. Thomas, where are you with this?
Yeah, I think fully agree. I think regulatory clarity is much needed. On the other side, it will also form, I think, the opportunity for the next 3 to 4 years. I think the people that are building now, that are being proactive, working with regulators, trying to help write the new rules for this new digital world, will be able to benefit from that. Just to give you an example, so we're very active in Brazil, and Governor Roberto Campos of the central bank in Brazil, he has a crazy love for crypto. He has a crazy love for tokenized assets. And so just a month ago, we sat together with him. We're going to be chairing a tokenized debt group. And you see immediately the amount of like indeed institutional players that have been sitting and waiting on the sideline that are ready to deploy. Just because of like that one simple trigger, like, okay, now we're going for it, we're gonna be providing some clarity and some sandboxes. And we expect that to be starting all over the world as well.
Yeah, I mean, I think we're in the same bucket across the board here, but for us, for different reasons. Essentially, we analyze open, accessible, raw data, right? This is not attached to any kind of end human, it's attached to a wallet, right, an externally owned account. And so if this data is raw and accessible, then do we fall under the purview of some specific jurisdiction? And then this opens up a whole can of worms around what identity means on chain. In the regulatory front also, I mean, you know, kind of the point I was alluding to before is existing credit risk infrastructure may have a lot of regulatory points already existing. When you go to these other emerging markets, credit risk infrastructure is non-existent. So what do you even do with something like that?
Absolutely. So we're early on. There's challenges, there's regulatory challenges, perception challenges, there's structural and technical challenges. How do we accelerate through that curve? What are some of the things we could do? Are there things we can do to help increase adoption in this space? And Sashir, I'll keep it with you.
Yeah. Actually, I think US dollar coin has actually enabled a lot of this, right? I mean, what you guys talked about earlier today with cross-chain support. Next year, you guys are going to roll out a euro. I think this current phase of this hybrid kind of TradFi's DeFi world that we're in, that you guys honestly have really have been at the forefront of, is probably the biggest kind of push for it. There's a lot of missing pieces in the DeFi world, such as credit risk infrastructure. And so then how do you bridge that kind of both sides of these worlds, right? You want to basically blur that line. And so there shouldn't be, for us, the way we look at it is there shouldn't be Web 2 financial history and Web 3 financial history. This is your just holistic financial history, right? Half of it may be completely neglected. And so we want to be able to bring that and attach it to your regular financial history. It shouldn't be DeFi and TradFi, it should just be Fi. There should just be finance.
That makes a lot of sense. Thomas, what do you think?
Yeah, so I think keep on focusing on solving real problems, right? I believe over time, for example, the whole bond market and everything will come on chain and trade on chain. But I think today in the short term, for example, there are industries in the US that don't get access to financing. There are emerging markets where the credit and liquidity gap is truly big. And DeFi, stable coins, blockchain in general does have a value add there. And so I think if we can keep focusing on improving that, solving a real problem, working with the regulators in proving that that is our focus, then we're going step by step.
That's it?
I think build in stages. So, we launched Maple. We didn't set ourselves the target of having absolutely every aspect of it on chain. So underwriting happens off chain. But that enabled us to start lending, start building the book, and getting the product awareness out there. So I think it's key to build in stages, have a 3-year vision, but then also have the things you can do immediately to start building your product, growing your usage, because the best way to win customers is to show that you have a working product. And so I think that's a huge thing. And then externally, what I would love to see is a seamless proliferation of on and off ramps. So we really like Circle's product. The ability for people to get into stablecoins and then use the infrastructure, use on-chain rails, borrow on-chain, lend on-chain. All of these things, the experience is 10 or 100 times better. And I very rarely see people start doing it and go back and decide they actually want to conduct most of their banking or their financial transactions out of a bank account. And so I think when that happens, when you have very seamless on and off ramps and a fintech can borrow through Maple, draw down USDC and have it arrive in a bank account and then pay salaries with it, that's when we can start to do apples to apples comparisons of products that are built on chain and just how much better they are than 50-year-old software built on COBOL.
Thank you for that. What about you, Erbal?
First of all, I'm a firm believer that adoption will happen regardless. Just with patience, all the macro indicators are kind of pushing more and more people to obviously look into what's happening here. Capitals, in traditional markets becoming more expensive. Access to capital is becoming tighter across the world. I was just telling Thomas backstage, the reason why Turkey appears in top list of crypto adoption is 80% inflation. And that is not only specific to Turkey, right? It's going to continue to happen in different parts of the world as well. So that's, I think, all indicating that this is going to continue to happen, adoption is going to come. The place we're focused on is maybe a bit more specific. When we started, building Huma, thanks to our, celebrity CTO, Richard, we got a lot of actually volunteers who wanted to intern with us for free. We were, forcing them to actually accept money, but they're like, we just want to learn. We just want to learn what's going on.
Absolutely.
And, they just wanted to, build something with us. But the main challenge for them is a huge steep curve to actually learn, the thing that you need to learn to even participate in these ecosystems. So we focused mostly our time on, building this income of adapters that any developer can write, building these, decentralized machine learning model infrastructure that anybody who knows Python and, some kind of data, limited amount of data science can start participating in. So I think we need to also lower the barriers for more people who want to build things, both on the, consumer and the business-facing side, but also on the infrastructure side to participate. And I think as more people who want to participate, being able to participate, it's just going to accelerate adoption.
Yeah, that makes a lot of sense. As we sort of wind down, what are one or two things that you're really excited about, things you're seeing, things that are possible, aside from some of the philosophical elements of DeFi and why we are generally, all of us, including very much Circle, so convicted that this space will only grow over time, which I think is, Erbil, one of your great points. What are the things you'd leave the audience with to whet their appetite to continue to follow the space and be invested in the future of DeFi? So Shir, I'll kick it down to you.
So for us, I think two things. First is accessibility. A lot of lenders, whether it's institutions or not, I think they leave a large part of the world kind of neglected because they don't actually know who to lend to. And so there's a larger addressable market across the globe here that becomes inclusive if you have risk infrastructure or risk analysis. And so there was this meme in the last cycle about banking the unbanked, and it was really just giving people a non-custodial wallet. All of a sudden you bank them, which I didn't really understand. But I think if you start to give them some credit risk infrastructure, now you know who you can lend to, what type of lending rates you can give them to. Now, the rest of the world actually becomes eligible for first world financial services. The second thing I'm really excited for is this kind of concept that we're calling programmable creditworthiness. And so because there's no risk infrastructure on chain, essentially you can't build a single source of truth or a black box machine learning algorithm and then ask these decentralized DeFi protocols to trust a single source of truth, right? It's not sufficient. And so once we build out this second phase of what we're doing of this kind of global network of credit scores, all of a sudden risk analysis and risk infrastructure becomes permissionless and trustless in a Web3 world. So entirely new applications become possible, right? So things like permissionless credit delegation, permissionless credit default swaps, new ways of doing tranche debt and lending with risk inherently built in, plus a lot of new things that we're not even wrapping our heads around, right? So DeFi, somebody invented self-repaying loans, completely new concept that wasn't even possible before. So we want to add that additional layer with risk inherently built in. And risk is kind of funny in DeFi because you wouldn't call traditional finance risk-based finance. Risk is always built in to everything in finance. But in DeFi, risk is just non-existent, right? And it's because it's really hard to build permissionless risk. So if we're able to achieve that, then entirely new application layers become enabled.
Indeed. Thomas?
Yeah, playing a bit on the banking the unbanked. So what really has excited us is to see the amount of impact that we were able to have. So, for example, we work in Brazil with a large company that is doing car loans. And we just recently visited them and we started speaking to some of those consumers that are actually getting the car loans. Now, they were able to tell us that previously they were not admitted a car loan. Because of that, they got a car, they were able to move to a big city or get a job into a big city, and they were able to increase their salaries, almost double it, and be able to take care of their family. At the same time, because we were able to package this in a tokenized version on-chain with full transparency of the underlying assets and the behavior, a large-scale institutional US-based asset manager financed this. whilst normally they would never touch that kind of credit. And so we have both created a positive impact and an economical value through DeFi as a platform. And of course, the person getting the car loan doesn't really care that it goes through DeFi, but I think they shouldn't. And seeing that small kind of impact that we can bring and do at scale to improve financial health and financial wellness globally, that's something that really excites us because something magical happens there that you feel like, okay, this is going to be big, this is going to have impact.
Absolutely. Sid?
I think access points, so more people engaging with the blockchain in day-to-day lives. So I think we were pretty excited when Solana launched the mobile and the mobile stack. So I think the more familiarized and used to interacting with the blockchain people are, the more it benefits projects like all of us on stage. And the other one, I mentioned before, but on and off ramp. So I think this is really the point at which, if they are done right, and there are more companies that are offering, an easy way to get in and participate on protocols by having a stable coin and having a wallet that can touch protocols like Maple or Credix or Huma, then that's where the adoption will increase 10 or 100x from here. So those are the two things we pay the most attention to. And yeah, that's what we're most excited about.
Amazing. Herbal?
I tend to think about the first time I came to the United States about 15 years ago. I only had access to literally one bank who wanted to, open a checking account for me, and everything else I asked for them to do for me, they said no. And that I think is the future is very bright because we already seen that it's starting to change. But I think the future we're going to have thousands of different types of applications, not just accessible from your phone or your computer. It's going to be, very different kind of financial products will be available to anybody who wants, regardless of their, citizenship, regardless of their asset class that they actually hold, or regardless of what age they are. And I think that's going to be a very exciting world because that will improve financial literacy. And improved financial literacy actually is going to have economic development opportunities opening up in places where the world needs the most. And without that, I think we don't have much to hope for. So I'm really excited about everything that will be built in the next 10 years and people who will access to them day one.
I'm excited as well. And with that, I will thank the audience for coming today. I hope all of you enjoyed listening to these guys as much as I enjoyed moderating the panel. Let's give them a nice round of applause.